Something feels off in the markets right now. Not volatile. Not bearish. Not even uncertain. Different. You can feel it when charts stop behaving the way textbooks say they should. You can feel it when rallies don't celebrate good news, and sell-offs don't need bad news. You can feel it when price moves faster than explanations can keep up. This isn't just noise. It's a shift in character. Markets usually operate within a rhythm. Trends form, pullbacks, respect levels. Volatility expands and contracts in recognizable cycles. But lately, that rhythm is breaking down. Moves are sharper. Reversals are faster. Levels that used to matter don't. And price is increasingly driven by urgency rather than agreement. That's your first clue. Normal. Markets are about negotiation. Buyers and sellers disagree, but they're still speaking the same language. Price moves because one side slowly gains conviction. Abnormal markets are different. They don't negotiate. They react. They lurch. They gap. They force decisions. And forced decisions are never comfortable. Here's the uncomfortable truth most people avoid. Markets don't become abnormal because of one event. They become abnormal when structure starts failing. Structure is the invisible framework that all holds price together. Liquidity, positioning, confidence and settlement. Trust in the system behind the trade. When structure is healthy, even bad news gets absorbed. When structure weakens, even good news can trigger chaos. Right now, we are seeing symptoms of structural strain. Liquidity is thinner than it appears. Participation is narrower. More volume is being driven by fewer players. And when fewer players control more flow, moves become exaggerated. This is why you're seeing rallies that feel desperate instead of confident. And sell-offs that feel sudden instead of logical. Another sign. The way correlations are breaking. Assets that used to move together no longer do. Hedges fail when they're needed most. Diversification feels weaker. That's not random. Correlations break when the market stops pricing assets based on growth and starts pricing them based on survival. Survival markets don't care about fair value. They care about exits, and when exits are crowded, price stops being polite. Let me give you a hard truth that professionals understand instinctively. Markets don't warn you before they change regimes. They signal. The signals are subtle at first. They look like overreactions. False breakouts. Weird volatility spikes. People dismiss them as just another crazy week. Until suddenly, it's not another week. It's the new normal. Here's where most viewers lose the plot. They keep asking, is this bullish or bearish? That question assumes the market is still behaving normally. In abnormal conditions, direction matters less than behavior. Ask better questions. Why are moves accelerating instead of stabilizing? Why are pullbacks failing to calm volatility? Why does price feel fragile even when it's rising? Those are regime questions. And regime changes are where fortunes are made or destroyed. There's a reason experienced traders sound calm when markets get violent. They've seen this movie before. Not the same assets. Not the same numbers. But the same behavior. Late cycle behavior. Stress behavior. Transition behavior. The moment when the old playbook stops working, but the new one hasn't been written yet. This is the phase where retail traders feel whiplash, where long-term investors feel uneasy, and where institutions quietly adjust risk while saying very little. If you're feeling unsettled, that's not weakness. That's perception. Your instincts are noticing something your feed hasn't explained yet. And if you're still watching, here's the key idea to hold on to as we move forward. Normal markets reward confidence. Abnormal markets punish certainty. If you treat this environment like a normal cycle, you will misread it, because this isn't normal market behavior. To understand what's happening now, you have to understand how markets behave before major transitions. Not crashes. Not rallies. Transitions. In a normal market, price discovery is slow. Buyers step in. Sellers respond. Volume builds gradually. But in transition phases, price discovery becomes violent. Why? Because the market is no longer debating value. It's questioning assumptions. Assumptions like, liquidity will always be there. Volatility will ravered. Someone else will take the other side. When those assumptions weaken, behavior changes. Fast. One of the clearest signs of abnormal behavior is how markets respond to stress. In normal conditions, stress leads to consolidation. In abnormal conditions, stress leads to acceleration. That's what you're seeing now. Bad news doesn't push markets down slowly. It triggers air pockets. Good news doesn't lead to sustainable rallies. It triggers short squeezes and exhaustion. Moves. This tells you something critical. Positioning is fragile. Fragile positioning means small catalysts create oversized reactions. That's not confidence. That's tension. Another sign. The shortening of time frames. Moves that used to take months now happen in days. Moves that used to take days now happen in hours. That compression of time is dangerous. It means risk is repricing faster than people can adapt. And when adaptation fails, mistakes compound. Here's where this gets uncomfortable. Markets behave abnormally when participants are forced to act. Not choosing to act, margin pressure, risk limits, redemptions, hedging obligations, forced activity. Destroys elegance. It turns smooth trends into jagged spikes. This is why technical analysis feels less reliable right now. Not because charts don't work, but because context changed. Support and resistance assume orderly auctions. But forced markets don't auction, they dump or chase. That's why levels get sliced through. That's why fakeouts multiply. And here's the trap most people fall into. They assume abnormal behavior is temporary. So they keep trading like normalcy will return any day now. Sometimes it does, but sometimes. This is the beginning of a longer phase. A phase where volatility stays elevated, where risk premiums expand, where price discovery becomes painful. These phases don't last forever, but they last long enough to destroy bad habits. Another hallmark of abnormal markets is narrative. Instability. Stories change rapidly. Certainty collapses. Experts disagree loudly. That's not confusion, it's recalibration. Markets are trying to reprice a world where old reference points no longer apply. Debt, growth, inflation, trust. When those variables shift together, the math changes. And when the math changes, behavior follows. This is why you're seeing people cling to extreme views. Everything is fine. Or everything is about to collapse. Both are coping mechanisms. Abnormal markets make moderation feel unsafe, but the professionals don't choose extremes. They choose flexibility. They reduce leverage. They widen expectations. They survive. If you want to stay ahead of this phase, stop asking when things will go back to normal. Start asking, what kind of market am I in right now? What behavior is being rewarded? What behavior is being punished? Because this environment is not about being right. It's about staying adaptable. And if you're still watching, here's the rehook you need. The most dangerous part of abnormal markets is not the volatility. It's the false sense of familiarity. When markets stop behaving normally, most people respond the wrong way. They try to force certainty onto uncertainty. Double down on conviction. They search for someone who sounds confident enough to follow. That instinct is human. It's also dangerous, abnormal. Markets don't reward conviction. They reward process. Process means you focus less on prediction and more on response. You stop asking, where will price be? And start asking, what will I do if this happens? That shift alone separates survivors from casualties. Here's how professionals reframe their thinking in abnormal environments. First, they respect volatility as information, not noise. Volatility is the market's way of saying, risk is being repriced. Fighting that message is expensive. Second, they size positions assuming wider outcomes. If your position only works in calm conditions, it doesn't belong in this market. Third, they accept that missed opportunities are cheaper than forced exits. You don't need to catch every move. You need to avoid the one that breaks you. Fourth, they watch behavior, not headlines. Headlines lag. Behavior leads. Watch how price reacts after big moves. Watch how quickly dips are BOTO or not. Watch whether volatility contracts or compounds. Those reactions tell you more than any forecast. And most importantly, they stay emotionally neutral. Abnormal markets feed on emotion. Fear and euphoria create liquidity for smarter players. Your job is not to provide that liquidity. Let me give you a principle worth remembering. When markets feel normal, you can afford to be aggressive. When markets feel abnormal, you must be precise. Precision beats bravery. Now here's the uncomfortable closing thought. Abnormal behavior doesn't always precede collapse. Sometimes it precedes repricing. Assets don't just go down. They reset. They find new ranges, new rules, new expectations. The people who navigate these periods, well, don't predict the future. They survive long enough to benefit from it. So if this market feels strange to you, don't ignore that feeling. Interrogate it, because the market is telling you something. And what it's saying, clearly, is this. This isn't normal market behavior.